Good morning and welcome to the September 3rd, 2020 investment meeting of the Teachers Retirement System. I'm going to start by calling the roll. John Adler.
I'm here.
Thomas Brown.
I'm here.
Natalie Green-Giles.
Here.
David Kazansky.
Present.
Russell Buckley.
Present.
Deborah Penny.
Here.
Susanna Vickers.
Here.
All right, we have a quorum and I'll turn it over to the chair.
Good morning, everyone, and welcome to September. So we start with passport funds, and we will go to Robin to start that off. Thank you.
Thank you, Madam Chair. So hello to everyone. I hope the summer went all right for everyone. I want to mention that my colleague Emma O'Brien is joining me today in place of Michael Fulvio. Mike is on parental leave until year end, although he's responding to questions and emails on an as needed basis. And Emma has been part of Rokatan for about 10 years, and she and I have collaborated on a number of client relationships, and she'll be providing some information today as well. We're going to start off with the second quarter 2020 passport funds performance. We are then going to move into the July performance and then look at August benchmark performance. And then that will be followed by a presentation by the Chief Market Strategist, Global Market Strategist at Invesco, one of your portfolio managers, at about 10:30. So if I can ask you to turn to, I don't know if anyone's, I don't have the ability to show these, to present this deck on Zoom, but everyone should have the attachment of the capital market of the second quarter performance. Is that correct?
And Robin, if you wanted to, you could share your screen.
Okay, but I'm using a different screen. Emma, can you do that?
No, I can't either.
Can Liz? Because that would be
Liz?
helpful. I would have to look on.
I can do it if you want. You want me to do it?
I have it. I can do it. I have it up.
Okay, great.
Thank you.
If someone could do it, that would be really helpful.
That'd be great. Thank you so much, Liz. So if Liz, if you could turn to page 3 of the deck. So this does seem a little bit, and I don't know if you have the ability to enlarge that on your screen.
I'm trying to get to that.
Okay, thank you.
That's just why doesn't lets me go.
Okay. There are a lot.
Yeah, the plus button.
There we go.
Oh, there you go. Little better.
Go.
Little better. Thank you. So I'm going to talk a little bit about capital market performance as of the end of the second quarter, and we're going to talk in more detail about performance in July and August. But I think that it's likely that everyone recalls that the second quarter was a very good quarter for equity markets, particularly U.S. equity market, a little less so international markets, and fixed income assets generally had positive performance as well as credit spreads came in. So the lower quality fixed income markets did particularly well as credit spreads came in. And so you can see some of the numbers quoted on this slide are for the second quarter. The Russell 3000 was up 22%. The S&P was up 20.5%. Again, this is for the second quarter. And you can see that mid-cap stocks did well. The global index was up almost 20% and so forth. And then we get to the high yield index, which is up almost 10%. So a very good quarter for credit linked securities. One thing that is worth noting is that there was still a very strong bifurcation of performance, and we'll see that as we go through the Passport Fund performance, still a very strong bifurcation in terms of growth versus value stocks. And so I will tell you that for the year-to-date performance, which is not on this chart, but I'm going to just give you some numbers. For the year-to-date through June, the S&P was up about 2%. The 5 largest stocks in the S&P, which are Facebook, Amazon, Apple, Microsoft, and Google or Alphabet, were up 35%. The other 495 stocks were down 5%. So, you know, market performance overall, reasonably robust, but really a very strong divide between large growth, technology-oriented stocks and the rest of the market. So with that, I'd like to ask you to, there's again a lot of detail in this report. I'm going to just go back to slide 26 if we can. Liz, if you don't mind. Great, thank you. And this is the flash report that everyone would have received for the periods ending June 30th. And you can see that variable A, the diversified equity fund, is up, was up to close to 14.7 billion. That was up versus 12.3 billion at the end of March. So being heavily invested in US equities in this fund, the assets grew significantly. You can see that for the 3 months ending June, this fund was up about 20.7%. And while that lagged behind the Russell 3000, again, because we weren't entirely invested in US equities, relative to the hybrid benchmark, we kept pace in a very strong market. You can see that the defensive strategies composite lagged its benchmark a little bit at 17.5%. The actively managed US equity composite was actually ahead for this 3-month period, but continues to lag significantly on a year-to-date basis. And I'm going to take 10 seconds to say that this is a conversation we've had over periodically and particularly over the last several meetings. And we are we have spent a fair amount of time during the summer working on an analysis of this US equity, actively managed US equity composite within variable A. That will be an agenda item at the October investment meeting. And finally, the international equity composite during the second quarter was up over 17% and continues to do well relative to the international composite benchmark. Just to remind you, this composite is about a third passively invested, with the rest of the composite actively managed. The balanced fund, which is slightly below, if we can, I'm looking at slide actually 24, if we can move up to 24. Yes, so the balanced fund generated a return of about 6.5%. This is an indexed fund, so it has an allocation to a global equity index and a short-term bond index, 2 Vanguard indexes, and there's a 70-30 weighting. And you can see that there was some tracking error for the 3 months ended June, and that's because of the fact that because of the volatility of the markets, this fund wasn't always at its 70-30 target weighting. And so because the asset allocation was off slightly, we lagged behind the benchmark slightly for the 3 months. The International Equity Fund, as we've noted, did very well in the second quarter, slightly ahead of its benchmark, so up over 17%. Still negative for the year-to-date period, but again, ahead of the more negative benchmark. The Sustainable Equity Fund did very, very well in the in the second quarter, up almost 29%. We're going to see that performance relative to the benchmark fell off during July. But you can see this is a growth-oriented, sustainable fund. The benchmark is growth-oriented. So you can see that the fund was up over almost 29% for the quarter, and for the year-to-date period, up almost 13%. So dramatically strong performance for the benchmark and the fund. And then, of course, we have, if you go down a little bit lower, we have the U.S. Equity Index Fund, which is a relatively new fund, only has 20 million in it. And there is, because the fund is relatively small in assets, cash flow and the timing of those cash flow have a significant impact on this fund's performance. So what you see in this U.S. Equity Index Fund, which Susan can also talk to, is the actual passport fund performance. And on a year-to-date basis, this passport fund is actually way ahead of the index. And that's because of the fact that, again, relatively small assets fund, and because of the very significant volatility of the market during this period of time, the actual date on which the funds flowed, the contributions flowed into this index fund had a very significant impact on relative performance. So the mutual fund in which this passport fund is invested tracked the benchmark, but because of the cash flows and the timing of those cash flows, the passport fund actually has outperformed the fund significantly on the index on a year-to-date basis. Same is true for the International Equity Index Fund, relatively new fund, relatively small assets, $3 million on a year-to-date basis. Because of the timing of cash flows, this passport fund has outperformed the benchmark. The mutual fund that it's invested in has tracked the benchmark, but the actual dollar-weighted returns of the passport fund are way ahead of the benchmark. And so I'm going to stop there. There's a lot more detail in this report, and I'm happy to go into any detail that you'd like. If
Just
you're
one
yes.
question.
Sure.
You mentioned, and
Yeah.
I was scattered for a bit. What's the issue that we're going to discuss at the October TDA meeting that you raised, Robin?
The actively managed U.S.
Got
equity
it.
composite within variable A.
Okay, perfect. Thank you.
If there are no further questions on the June report, we have a July month-end report that Emma's going to present briefly.
Okay, welcome, Emma.
Good morning. Thank you.
Good morning.
Liz, do you think you could bring that up? Really appreciate your help. Thank you.
Robin, will we be able to just go through it without bringing up the report?
Yeah, I think we can highlight some of the,
Okay, thank you.
sure. Emma?
Okay,
can you
great.
talk-
Sure. So if you're on the first page of the July report, I wanted to spend a minute just walking through what we saw more broadly within capital markets. In July, there was positive performance across most major asset classes. U.S. large cap markets were up almost 6%. U.S. small cap markets were up almost 3%. Non-U.S. developed up about 2.25%, and emerging markets up 9% for the month of July. We also saw broad market fixed income with positive performance, returning 1.5% in July. As Robin had noted, as she was going through her market commentary, we've seen a continued dispersion between growth and value. And this has been the case over the last several years, really over the last decade. And it's really been especially pronounced year to date. So if we look at the Russell 3000 growth, which is a measure of the US equity market and the growth stocks within that market, that was up 17.1% year to date. The Russell 3000 value was down 13.5%. So that's about a 30% dispersion between growth and value stocks within the US market. We also continue to see large cap markets outperform small cap markets, particularly within the year-to-date period. The Russell 1000, which is a measure of large cap equity markets within the US, that was up about 3%, whereas the small cap market, as measured by the Russell 2000, was down 10.5%. So that's about a 13% dispersion between large cap and small cap stocks. If we look at performance for the passport funds, starting with the diversified equity fund, this returned 5.4% in July, which beat the hybrid benchmark by 11 basis points and trailed the broader Russell 3000 benchmark by about 30 basis points. If we look over the year-to-date period, the diversified equity fund is down 1% versus a return of about 40 basis points for the hybrid benchmark and 2% for the Russell 3000. Now, there's really three key drivers of performance for the year-to-date period relative to the Russell 3000. First, you have the international equity allocation. So if you look at the international equity composite line item, that was down 5% for the year-to-date period. And while performance relative to the benchmark is strong and your active managers have delivered strong performance, the international markets have not kept pace with the US markets. So when comparing to the Russell 3000, it is detracted on an absolute basis. Within your defensive strategies composite, your low vol managers in particular didn't protect on the downside during the first quarter. And that return of 2.8% was really driven by the convertibles allocation, but not necessarily performing as designed as a result of the low vol managers. And lastly, your active managed US equity composite. This was down 9.7% for the year-to-date period relative to 2% return for the Russell 3000 index. And that's really driven by the value tilt within the portfolio. So if you look under the hood, the relative performance for your active managers within the US equity composite is really strong. 6 of the 7 managers are outperforming the relative benchmarks, but you do have a value tilt, and as value has underperformed growth, you've seen this composite lag the Russell 3000. Any questions on the diversified equity fund before I move on?
Yeah, I just have a question, Emma. I didn't understand when you were talking about the defensive strategies composite, and you talked, I think, about performance driven by the convertibles managers and that the low vol managers underperformed. So when you say, so are you saying that the convertibles managers outperformed, or are you saying the underperformance is a result of their underperformance? I just didn't understand what you were saying.
So when thinking about it on an absolute basis, your low vol managers were down about 1% for the year-to-date period relative to the broader market return of 2% for the Russell 3000. Your convertibles managers were up double-digit return, so in the 13 to 15% range. So that 2.81% return that you're seeing for the year-to-date period, that's really driven by your convertibles allocation.
In other words,
no, I think it's driven by the low vol allocation, right?
When you say
yes, the low vol allocation is brought
I think
down.
I think you're substituting converts for low vol. The issue is the low vol managers in that composite have had negative performance for the year to date. The convertibles managers have generally performed as expected.
But the convertibles market has outperformed. Is that what you're saying? And the
the convertibles market has been strong. Yeah.
Right. Okay. Got it.
Yeah.
That's what I didn't understand.
I caught that too.
Okay. Thank you.
When looking at the balance fund return, this was in line with the benchmark for the month of July. On a year-to-date period, it's trailing by about 40 basis points. And as Robin had mentioned for the June update, this is really just a function of the extreme market moves and not being constantly at the 730 target. The International Equity Fund outperforming for the month of July, outperforming year-to-date. You've seen strong relative performance, particularly from your core and growth managers. And lastly, to hit on the US Equity Index Fund and the International Equity Index Fund, both were trailing the benchmark for the month period. If you look at the year to date, you'll see the performance dispersion from the benchmark and some higher tracking. As Robin mentioned, this is due to some cash flows that occurred in March during the periods of market volatility. I'll stop there and see if there's any questions on the July performance.
Okay, I guess there are no questions. Anyone? All right, so Robin, are we ready for the presentation then?
Yeah, I just did want to refer to the benchmark performance for August that was distributed by Liz, I think yesterday. And I think the only thing to note is that more of the same. Equity market, the US equity market was up over 7% for the month of August. International stocks were up about 5%. And so our estimate for variable A for the month, the hybrid benchmark, is about 6.7%. And that would get us to a calendar year-to-date return of 7%. So continued strong equity market returns over the month of August, contributing to offsetting the losses we saw in the first quarter. More of the same.
Okay.
And that's a good thing for as long as it lasts.
Just hoping.
Yeah. So because this is the first meeting of the school year, and because it's been such an interesting calendar year to date, using air quotes for the word interesting, we thought it might make sense just to have one of your managers talk about what they're seeing going on in the capital markets and what their outlook is. And so Invesco is one of your managers in the Passport funds, and we've invited them to present. Hopefully they're in the waiting room. Is that right, Liz?
Yes, they are waiting.
Okay. Should we let them in now?
What I'm going to do is I'm going to wait for you guys to go into executive session, and then I'm moving everyone over to the executive session room.
Liz, I think this is public session.
It's still public session.
Oh,
Yeah.
okay.
Yep.
Yeah.
I'll let them in now. They're coming. They'll be joining us.
Thank you.
Good morning.
Well,
Good morning.
Dicey.
How are you?
Christina.
How are you, Deborah? How are you? Hi, Liz. Hi, Robin.
Good.
Hello.
Hey, Dicey.
Hi.
Welcome.
Hello, David. How are you?
Great, thanks.
Good, good. Let's see. I think Christina was in waiting mode, and
Yep, we see Christina.
Can you hear me?
Yes.
Okay,
Yes,
great.
we can hear you. We can hear Dicey. We can't see Dicey.
oh, I'm sorry.
That's okay.
I'm
Oh,
sorry.
well, there you go.
Hi, guys. Hey,
See that
good morning
beautiful
to everyone.
face.
Good to see everyone. Hi, Tom. Hi, John. Susan.
So Dicey, do you want to take the floor and introduce for the few people on the call who don't know you?
Yes, I don't know
yourself
you,
and
Dicey.
Christina.
I'm Natalie Green-Giles. I'm one of
Hi,
the
Natalie.
board members. Nice to meet you.
Good to meet you. Well, good morning to everyone. I am Dicey Ellis Beckham. I'm the relationship manager for the convertibles mandate. We manage on behalf of New York City Teachers Retirement, the 403B plan, and honored to work with all of you. A pleasure to meet those who I do not know, and for those I do know, it's great to see your faces. And we just thank you for our partnership and our relationship, and we thank Robin and Rokatan for our meeting today to share our macro overview. Christina has presented to quite a few boards of late and been able to provide some value, and we look forward to your interest and your questions.
Well, thank you. Is it okay for me to just get started?
Sure. Maybe you could just talk for 1 minute, Christine, about your role at Invesco.
Yes, absolutely. So I'm the Chief Global Market Strategist, and I run a team of strategists and analysts based around the world. So I have several of my colleagues are in Asia Pacific, several of my colleagues are in Europe, and several are in North America. And that enables us to give not just a top-down perspective, but really a bottom-up kind of grassroots perspective on what's going on in different major economies that helps us form our worldview. What we try to do, though, is always be as holistic as possible in terms of looking at all the potential factors impacting the economic outlook. This is particularly important now in the midst of a pandemic, but it's something we consistently try to do. And then, of course, also talk about the investment implications of what's going on. Sometimes we can all get so caught up in a macro discussion that we forget about what it means for markets, what it means for investments. So we try to do that as well. So that's a little bit on me. I have to tell you, I'm really excited to be with you all today. My grandmother was a proud New York City educator. She taught, I want to say, for over 40 years, and she spent about 25 of those years in Jamaica Estates. Although my mom couldn't remember offhand the PS number, but she was a kindergarten teacher. So it is really awesome to be with you all.
Great, thank you.
Awesome. Okay, well, let me get started. And Dicey, you have the slide deck. So if we could move to the second slide. I think one of the big questions we get is on, and I'm just going to talk while while we wait for it to pop up on screen. But one of the big questions, of course, on everyone's mind is, what is the shape of this recovery?
One second, can you guys see? Can you
I can see.
Yes. Yes.
Okay, just want to make sure.
Yes.
I'm getting used to the new. Okay, just want to make sure.
You just might want to put it in slideshow mode so it's bigger, Dicey.
Okay, I will try that.
And it just told it just gave the instructions on how to do it. I think it's like control something, but even at the bottom, you might be able to hit the icon for full screen.
Okay. I will try. You can continue,
Oh, yeah.
and I'm
going to keep talking. So, one of the big questions, of course, is, what does this look like? And so, this gives some sense of historically what we have seen, including the Great Depression. We are certainly not in a Great Depression, but there are real threats to how this economic recovery materializes. And so there are still question marks. I don't think this is a true V-shaped recovery, but there are certainly question marks about what kind of recovery it is, which I'll talk about in a moment. But if you turn to the next slide, what you'll see is some of the factors that we think are playing a critical role in the shape of the recovery. It's not just about the infection rates, it's about the development of therapies as well as a vaccine. The best experts that we've heard from, and what we try to do is get a lot of expert opinions to kind of help us understand what's going on, especially in an area where we don't have a high level of expertise like healthcare. It sounds as though it's most likely that a vaccine is arrived at by the second quarter of 2021. Although distribution is already being queued up, so it should be a more rapid distribution than what we've seen in the past. So I just share that with you as something of a base case. We'll see what happens there, but that's a critical factor. Even the development of therapies. If for example, therapies like remdesivir, which have already shown some promise, continue to be utilized and have good results, that can make a difference as well in the kind of recovery we see. Stringency measures, mobility, I will say stringency measures mattered a lot more in the spring when governments were very serious about lockdowns. Not so much anymore. Now it's up to individuals to decide what they're doing. And so mobility plays a bigger role. So we use Google mobility tracking to understand just how much of a population in a given economy is moving around. Of course, that all leads to economic activity. And what we're actually spending on, what we're doing, and how the economy is moving. And there's certainly, it's a situation where there are haves and have-nots, which I'll get into in a moment. And then, of course, fiscal stimulus and monetary stimulus all play an important role. Now, I should delineate that fiscal stimulus has a much greater impact on the economy. Monetary stimulus on the margins can certainly help the economy. We've seen the Fed create specific facilities, but the reality is that monetary policy in general has a much greater impact on capital markets than it does on the economy. So if you turn to the next slide, what you'll see is our 5 different scenarios. Now, we felt as though to be true to the process of creating an outlook, we really needed to consider a variety of different scenarios, given that there are so many factors at play. So our central scenario, our base case, so to speak, or intermediate case, as you can see here, is a Nike swoosh shape recovery. So think of it as something that ultimately looks more like a V-shaped recovery, but is very halting and uneven, much weaker in its initial stages. And we assign that the highest probability of any scenario, as you can see, a 40% probability. And that assumes a gradual return to normal behavior. I have to give the caveat that that assumes that there will not be a significant second wave. And I think that remains to be seen, especially as we are in the midst of back to school season. And then, of course, as we head into flu season, this could very well not ultimately be reality. But right now, we believe that the United States has become better equipped at managing the virus. We know other countries have become much better equipped at managing it, especially Asian countries. They have just done a great job with creating a contact tracing infrastructure, et cetera. So any kind of spike gets tamped down very, very quickly. Our worst case scenario, which we only assign a 5% probability to, is that W-shaped recovery. That would look a lot like what you saw in that earlier slide in terms of the Great Depression. We don't expect to see that, but that would be multiple waves of the infection requiring strong lockdowns. Again, we think that governments have moved away from the idea of having wholesale, very, very strict lockdowns. Bad case scenario has a 25% probability, so we should pay attention to it. That suggests a second wave in later 2020, and that would be something of a partial reimposition of lockdowns. And of course, what we're seeing more and more is individual behaviors changing and doing less and reacting to any kind of increase in infection rates without actually having state-mandated lockdowns. We think there's a good chance of a U-shaped recovery, that we see advances in therapies helping along a faster development of a vaccine, all of which could return us back to normal behavior sooner rather than later. That's a 20% probability. And of course, the best case scenario would be very hard to have happen, but has a higher probability than worst case scenario. And that's the idea that we see that rapid easing of lockdowns, a speedy return to normal behavior. The problem is that that would also mean we'd need fiscal stimulus very quickly, and fiscal stimulus that is very significant. And that is one of the things that we think is unlikely to happen anytime soon. And I'll get into that in a minute. But if you turn to the next slide, what you'll see is, actually, let me move on because I'm in the interest of time, I'm going to keep going. You don't need this. This just gives us a sense of where we are relative to other pandemics. But what you can see is the United States has had real difficulty bending the curve. We're not alone. There are certainly a number of EM countries that have had issues as well. And quite frankly, India is a real problem because it has not been able to bend the curve, and it is already rolling back lockdown measures. So something we want to pay close attention to. That's why we believe very strongly that we can't look at EM as one asset class. We really have to break it down because of the differing levels of success there with combating the virus. If you turn to the next slide, you'll see more on that. This will give you a sense of how curve flattening has evolved. And this is a rolling 7-day average, which smooths things out a bit. We've had a spike in some countries in the Eurozone that we're very concerned about and that we're following closely. But in particular, Spain and France are issues. Italy also has had a higher number of cases in recent days than it had in May. So it's something we want to watch closely. If you turn to the next slide, this will just give you more on what's happening. I'm just going to scroll through again to the next slide. And you'll see the United States. It's hard to talk about the United States in gross generalizations because we know that different regions are in very, very different places. The Northeast managed this crisis earlier. We also had a very high level of deaths. And that has a lot to do with the learning that comes from living through something as horrific as this pandemic. Doctors learned that they were too quickly putting patients on ventilators, for example, and those best practices that were learned in the Northeast enabled other parts of the country to really dial down the mortality that was seen in the Northeast. But as you can see, this is not a situation that is extremely well under control. There are states where cases are on the rise, and in fact, Iowa and Alabama are two of those states right now. And we're very concerned and following closely school reopenings and what that could do. The CDC came out with a report on a Georgia camp in late June, in which every camper was required to, every camp staffer was required to wear a mask. Campers weren't. And in the course of 4 days, about 76% of those at the camp that were tested were positive for COVID-19. That's a worst case scenario. There are also stories about, for example, there are 4 camps in Maine where they were really able to avoid it using probably better practices than were at the Georgia camp. But of course, back to school is a real area of concern. And as I said, Iowa and Alabama, 2 areas where a lot of that has been tied to college reopenings. If you turn to the next slide, and I'll move through these quickly so we have enough time for questions. Also, feel free if you want to interrupt me as I'm going through this, if there's anything that catches you. Otherwise, I'll leave ample time for questions. This gives you a sense of what's happening in key economies. And you can see there has been a resurgence in South Korea, again, off a very, very low base. South Korea has never had significant issues and really such a low mortality rate. Japan has had more of a resurgence, but most countries, and as I mentioned, France and Spain are areas of concern. But even Brazil has been able to control it somewhat. China, of course, I think is a best case scenario model for what other countries can do. But again, South Korea also is in very good shape, and contact tracing has been excellent. So that spike is, again, a very small number. You have to look at the scale that each of these countries are on. So there's really no comparison between, say, South Korea and, for example, the United States. If you turn to the next slide, you'll just see Asia in particular, and this will give you a sense of where we are there. And I'm just going to move on to the next slide and keep going if you don't mind, Dicey. This will give a sense of the cases in North America. Mexico has been able to manage this a bit better as of late. Canada's in a good place as well. And if you move on to the next slide, what you'll see is another key component, as I said, of our outlook has to be the development of therapies and a vaccine. So this just gives you a sense of where we are today. Certainly, Operation Warp Speed is pushing biotech companies and pharmas to come up with a vaccine as quickly as possible. You can see there are a significant number of companies that are already in phase 3. But phase 3 trials could take some time. I think Dr. Fauci has suggested that we could have something viable by the end of this year. Again, we think based on our conversations with experts, that's probably a very optimistic scenario, but again, could happen. But we're watching this closely because it has a lot to do with the outlook. But again, once we have a development of vaccine, it should be very positive for markets, but it'll take longer to filter into the economy because of the time it takes to distribute the vaccine. Some of the vaccines that are being developed, for example, require 2 inoculations rather than 1. So there are a lot of issues about exactly how long it would take to impact enough of the population to allow for a return to normal. If you turn to the next slide, what you'll see is stringency. Now, I mentioned that this spring, stringency was a great indicator of economic activity because the lockdowns were so severe that it told us how much we'd see in the way of economic activity deteriorating. There was such a strong correlation. But that has changed because so many governments have decided against having those broad lockdowns. So if you turn to the next slide, what you'll see is mobility tracking. Now, in this particular chart, we're looking at global mobility. That's not really that helpful, right? Because so many economies are reacting differently because they have different levels of control over the infection. But this should give you some sense of, first of all, the ability to track activity by a variety of different categories, which is so helpful. And again, this comes from Google. They've made this available, at least temporarily, for free. So it's a wonderful way to track what's going on. And this gives us a sense of how the economy is picking up and improving. Retail and recreation include restaurants, the visits to shopping centers and restaurants, and certainly that's something we follow very closely. And as you can see, has improved a lot, really started improving in April, but has, for the most part, remained at a pretty steady level recently. We don't think we'll see much change until there's something that moves the needle in terms of the development of a therapy or vaccine. And of course, we have the potential for it to go down if we see any kind of increase in infection rates. If you turn to the next slide, there certainly is a relationship between, of course, mobility, we think, and what we're seeing in terms of stimulus packages, and of course, the impact on stocks. And so what we've done is juxtaposed the MSCI World Price Index, which is the royal blue line, with the darker blue line, which is the 7-day moving average of mobility, with stringency. So stringency has become relatively irrelevant now. It's really handed over the reins in terms of importance to mobility. But there's an interesting correlation there, I would argue, between mobility and the stock market, certainly helped along, I think, by some stimulus. If you turn to the next slide, this just gives a sense of mobility across the globe and gives you some insight into specific major economies. And of course, mobility has, as you saw in the global slide, mobility has improved very dramatically from spring to summer. And that explains a lot of the much improved economic data we've seen. We just haven't seen much in the way of improvement in mobility data recently. And if you look at the Eurozone, mobility data has gone down. That should be no surprise given that we've seen that spike in infections in some of the countries in Europe. If you turn to the next slide, Of course, we're looking at a lot of high frequency data. So not just mobility, but we're looking at consumer spending. We're looking at sentiment. And that, of course, helps us formulate our views. And what we do is get together every quarter to specifically tackle those 5 scenarios and decide whether or not we need to alter them in terms of, in particular, what our base case might be, but of course, what our other cases might be and the probabilities we would assign to them. If you turn to the next slide, you'll certainly see that improvement in green, in economic activity. Q2 and Q3, but again, a leveling off in Q3 that I think is important to note. I think there needs to be some kind of catalyst going forward. In Europe, it could very well be the kind of fiscal stimulus we're seeing coming from not just the European Union, but individual countries. In the US, certainly that we would be helped by another fiscal stimulus package. If you turn to the next slide, this just gives you some insight into the US in particular. While we've had some very positive jobs data, we have to recognize there was a massive, massive loss of jobs. My concern is that there are a lot of companies that are continuing to lay off workers. So while yes, some have been hired back, others are at risk of losing their jobs. And unfortunately, this is one of those crises that has disproportionately affected lower income Americans. And I can't say enough about how vulnerable they were before this crisis. The Fed does a survey of consumer finances every 3 years, and the most recent survey came out actually soon before the pandemic began. And it showed that 37% of households in America would not have enough savings to cover a $400 emergency expense. And of course, many of those households are under extreme pressure now, and it's a real problem. One other area I should call out as something we're concerned with is local and state government employees. Jay Powell, the chair of the Federal Reserve, has been very clear about the importance of government employees. I think something that often can be overlooked by policymakers. But the reality is 13% of those employed in the United States derive their employment from governments, and a lot of those are state and local governments. And of course, state and local governments are under enormous pressure. Some states, of course, have balanced budget requirements, and this is a very serious issue. The HEROES Act allocated almost $1 billion in aid to state and local governments. It doesn't look like anything like the HEROES Act is going to get passed if we do see a stimulus bill. So again, we're very, very concerned about employment and the employment situation, even though certainly the headlines note that we have seen big gains in the last few months. If you turn to the next slide, this gives you a sense of the room for maneuvering in terms of fiscal stimulus. And what you can see is that not only are a lot of countries under pressure in terms of not having balanced budgets, but many have high debt to GDP levels. But this should be some indicator of how much can be taken on. If you turn to the next slide, this gives a sense of where the US is relative to other countries. And as you can see, we're not nearly as much as a percentage of GDP as some of the other countries. And there's really a need for more there. Direct fiscal stimulus, of course, is most important. That's in dark blue. And if you keep moving, this just gives you more on the CARES Act, how it's broken down. But let me stop there because I recognize that we're running out of time, and I apologize for running over a bit. But what questions do you have for me? What I would like to do is just give you the bottom line, which is that our expectation is the economy is going to recover, but it's not going to be a strong recovery in the next few months. And there is that potential for some kind of slowing of the pace of the recovery. But we do think that changes, and later stages are much more robust. But what that means for capital markets is not a lot, because the Fed is really dominating what's happening there. And that means risk assets are supported. There's an upward bias for stocks and other risk assets like high yield bonds, like convertible bonds, even investment grade. There are specific Fed facilities that are supporting parts of the fixed income market, in fact. And of course, there's a place for alternatives. I think this is an environment where we have high geopolitical risk. Some investors are concerned about inflation, and so we're going to see alternatives like gold continue to be popular and probably make some price gains. But let me open it up for questions from you. And again, sorry for going on. Yes, please.
Is that me?
John,
It's
yes.
Yeah,
John.
okay. Well, so the first time I think I heard you utter the word political was when you just talked in just the most recent thing you said about geopolitical risks. And there is a somewhat important political event happening later this year in the United States. And I wondered what your view is of the risks associated with either a Biden victory, a Trump victory, or maybe a none of the above for some extended period of time.
So the big risk with a Trump victory is, of course, in the near term, trade policy issues. The United States could very well embark on trade wars with a number of different countries. And that could create an environment where we become even more deglobalized, which is a huge risk for companies because it makes production less efficient. So I think that's the single biggest shorter term risk from a Trump presidency. The longer term risks, of course, are the erosion in stature of the United States, a lack of control over foreign policy, essentially, creating a power vacuum, things that have less to do with markets, but are obviously important issues. The biggest risk with a Biden presidency is that he has told everyone he's going to raise taxes. And of course, corporations are concerned because the target would be an increase in corporate taxes. I will say that I'm not sure that in a Biden presidency, he'd be able to get past any kind of tax increases anytime soon. Just in sort of looking at the composition of the Senate, there are some more conservative Democrats, certainly supporters of Joe Biden, but wouldn't be supportive of a tax hike, which actually makes sense in an environment right now where the economy is still very much in recovery mode and needs time to heal and needs more stimulus, not less. So to me, that's the situation and what the risks are for those two potential outcomes. Of course, everyone's worried about that third outcome, which is litigation of the election, and in particular, President Trump refusing to step down. And that could be very, very problematic for markets in the short run. We could see a high level of volatility. I don't think we would see a massive correction for stocks just because the Fed has become even more accommodative with the policy change on inflation targeting last week. Where I think we would see the impact, of course, not just volatility would be going up, but gold would be going up. U.S., it remains to be seen what would happen with U.S. Treasuries, but they'd probably be perceived as a safe haven, not as much of a safe haven though as gold in an environment with so much uncertainty. But I think it could be very problematic in the short term for markets because, let's face it, markets don't like uncertainty.
Thank you.
You're welcome.
Okay, any other questions for Christina?
Hi, this is Cindy. I had a question. You briefly touched on the issue of city and municipal and state finances and the challenges, but budgets, two budgets that all of us are facing. If there's no support and then we start seeing municipalities and cities having to lay off governmental workers, including teachers, police, fire, how do you see those types of actions impacting the markets? For instance, if, the city of New York, they've floated potential layoffs of 22,000 city employees. That's a huge number. How those types of actions would impact the markets, given that it doesn't look like from Washington.
So there really has been a true decoupling of the stock market from the economy. It's something we also saw in the global financial crisis once the Fed stepped in and started QE. And that really has been the case this time as well. What I think that does is insulate markets from damage done to the economy. So I don't think that we would see any kind of significant impact on markets if we saw a big loss of jobs for municipal, for government workers. As much as that doesn't seem logical, that's really what's happening just because monetary policy accommodation has become just so over accommodative. Now, that doesn't mean it won't impact the economy. It will be problematic. And that's why Jay Powell is stepping out of his comfort zone and really becoming very, very vocal on this issue and urging Congress to act with an appropriate fiscal stimulus package. And I think the positive is that if you do get a Biden presidency, it would not be dissimilar to what we saw in the changeover from Bush to Obama. Remember, the global financial crisis started with Bush. We didn't get much in the way of fiscal stimulus, but we did get more once Obama was elected and we had enough legislators come in on his coattails. Now, I would argue that the fiscal stimulus, even from Obama, wasn't enough, but it certainly was an improvement, and we could see a scenario like that where we get more in the way of fiscal stimulus from a Biden presidency. Any other? Have I done enough to talk about investment implications? Are there any questions on that, especially specific asset classes?
I think we're good. You did a great job. We appreciate it. Thank you.
My pleasure. I'm sorry I didn't go through all the slides. I just wanted to give you enough time to ask questions. But let me just leave you with some broad themes, if you don't mind. We have very significant debt levels right now in the United States. In fact, the projection for next year is that our debt reaches GDP, and we haven't seen that since the World War II era. So we have to recognize that that's going to be an issue in future years. I don't think it's an immediate concern, but I think in general what we're going to see is monetary policy that's a lot lower for a lot longer. So yield scarcity is going to be an issue. We're going to have to continue to look creatively for yields. And finally, I would just say that we do have to pay attention to those bigger themes like deglobalization. If that were to continue to occur, it would have an impact on the multinational companies, so more of the S&P 500 companies, in terms of how they do business and their expenses and how efficient they can be. So just a few things to think about, but I have to tell you, I've been pleasantly surprised so far with the level of economic activity we've seen. It could have been worse, actually, given the kind of environment we've been in globally. China, in particular, has made a really strong recovery.
Okay.
Well, thank you so much for having me. I know it's hard to do justice to this topic in a half an hour, but if you have any follow-up questions, and I apologize for running over, but if you have any follow-up questions, I'm more than happy to answer them by email, send them back through Dicey. And really, just if there's anything you need in terms of follow-up information, I'm happy to provide that in slides as well. You may have questions, especially after you go through all the slides.
All right. Thank you, Christina. Thank you, Dicey. Thanks for joining us. Be well.
You too, and enjoy the rest of your board meeting. Thank you very much. Enjoy the long holiday weekend as well.
Thank you.
Thanks,
as well.
you too.
Good to see everyone. Bye-bye.
Thanks for having me.
Thank you.
Bye-bye.
Thank you. Okay, we're back. All right, we have one more thing. We have the review of the Passport Fund's investment policy statement. Susan, are you going to speak on that? Or Susan, go.
I'll unmute myself. Okay, so can everyone hear? Okay.
Yes.
Okay, John, thanks a lot for your comments that we got on Monday night. They were very helpful. we're prepared to address some of them today. You know, first off, you're exactly right. The balance fund is all passive, so that was an error. So we'll correct that. We should put in a sentence about the actuary's role in the rebalancing between the TDA and the pension fund. That's correct. And two more substantive issues that we can address today are both SEC lending and the basket clause. I'll talk about the SEC lending and then I'll punt it to legal. I don't know if that's going to be Isaac or Valerie to talk about the basket clause. On the SEC lending topic, yes, we do it. Yes, the section should be beefed up as you suggested. You are exactly correct. You know, if we want to go into on a very high level, our collateral pool is as conservative as possible. It's 90, you know, it's governments or agencies at Ginnie Mae's. The average collateral level is at 104%. Because it's so conservative and because interest rates are so low, we don't make a whole lot of money from the program. We make like $2 million a year, but we have very few loans outstanding in general. Basically, because our collateral pool is so conservative, the only things that go out on loan are things that are quote unquote on special, that people who are shorting really are paying extra. So that's the bottom line on the securities lending program.
Can I just ask a question about it? And because we've never, at least since I've been here, I don't think we've ever talked about securities lending. So I'm not actually familiar with the program here at Teachers. And I think my question is, I hear you saying that it's kind of a low risk securities lending program. I would still sort of appreciate a conversation about whether the gains are worth the risk, whether the benefits are worth the risk, and also would like to understand what happened at Teachers in 2008 when a lot of securities lending programs ran into trouble, including at the city's DCP, and I believe at the QPP as well, but I wasn't here, so I don't know for a fact.
Okay,
And we don't have to do that today, I don't think.
We can do that in October. We can do the whole thing. Okay. We have done some updates on securities lending, but obviously not often enough, or you wouldn't have had the question. So there you go.
And my guess is some of the other trustees may have similar questions.
Exactly. Exactly.
My tenure.
Time.
Some of them.
Good. Okay. So does
and not to disagree with you, John, but yes, I recall several discussions that we've had about the securities lending program over the years. So we have discussed it. Maybe not in the detail you want, but we definitely have discussed it.
Okay, great.
And just a reminder, we worked on a nice updated description of the program for the updated QPP IPS.
Okay. But that's different, I think, from the TDA program, I believe.
Right, you had mentioned the QPP, so I just wanted to remind you that there's a whole overview of the program, which I think is similar to the TDA.
Ours is even more concerned. Anyway, we'll have a presentation for that for October, and we can hash it all out then in detail.
Great, thank you.
Or as detail as you can stand. Okay, so now I'm punting it to Isaac or Valerie to talk about the basket clause and how it does apply to the TDA.
Okay, I'll start, and if I say something wrong, Isaac or David, you can jump in. So there is a section on eligible investments in the IPS, and the variable program does invest pursuant to a legal list, and that's set forth in the administrative code and the RSSL. Both the administrative code and the RSSL have basket clauses. And John, I think your question specifically was you were not familiar with the basket clause in the administrative code.
Is that the one? That's the one with the, it was
15%.
Yeah, the 15%. I'd never heard of that one.
Okay, it does exist, you know, and how the administrative code works with the RSSL, I mean, your head could explode if you tried to go into the details. I would say if there was
Let's
the
avoid.
biggest, so we won't. That would get ugly.
That's not pleasant.
Yeah. We thought it was appropriate to mention the basket clause in the administrative code, which is why you see it. More often than not, if we were to bump up against the basket, it would be the RSSL 25% limitation that would apply. There arguably are instances where it would be the 15%. As a practical matter, we are nowhere near basket limitations on the variable program. So we could discuss it further, but again, as a practical matter, us hitting any of these limitations, it's extremely remote. That's it. I'd say, what's the biggest difference between what's permissible under the administrative code versus the RSSL? And I think it will resonate with the board because of requested legislation, is there is actually not that 10% limitation for foreign securities for the variable. That technically could be kind of 100% foreign securities. I mean, maybe restrictions on the type, but we do not have that 10% limitation after which stuff counts towards the basket. So if you had any other questions, we could answer them.
Well, let me just ask one question. In this section, let me start with the RSSL section. It says pooled investment vehicles. And we do have some investments, I think, in pooled investment vehicles like the mutual funds that the balance fund is invested in now. And I think there's a handful of others. Does that count towards the 25% basket?
I don't think so.
What does it
my
mean?
Answer.
What is it? What are pooled investment vehicles? What does that refer to?
That would be, to me, that's a commingled fund.
Well, what's a commingled fund if a mutual fund is not a commingled fund? What is it? What is
well,
I
think that would be
a mutual fund.
It would be a mutual fund or another fund that had more than one investor.
So my question is right now, and also let me just ask something else, but let me finish with this. I just want to understand what is applicable to the basket clause. So we just created an equity index fund and an international, a U.S. equity and an international index fund, which I believe are invested in mutual funds, if I'm not mistaken. And also the balance fund is invested in 2 mutual funds, I believe. So are those funds considered pooled investment vehicles that qualify, that would be counted against the basket in RSSL 177?
I think the answer is they do not count towards the basket.
Correct.
David, do you disagree?
Valerie, I think they may. I was just double checking while we speak, but I just want to recheck that very quickly.
Under the RSSL.
Yes.
But we also have the administrative code.
Right,
if it's
correct.
authorized under the administrative code, that would be the relevant section.
And this goes to Valerie's point, and I think to Isaac's point a second ago as well. It's sort of trying to harmonize the two. I believe that under the, and I'm double checking it right as we speak.
Yeah, I don't have the provision open.
Yeah, but you guys don't have to answer today.
Okay, great.
So right. This language raised these questions for me because when I read pooled investment vehicles, I think that's, or a commingled fund, it doesn't say commingled fund, it says pooled investment vehicles, but I think mutual funds are that. So my follow-up question is are the restrictions, the 25% for the RSSL or the 15% under the ad code, do those refer to the variable program as a whole or to each fund within the variable program?
It's an aggregate. So as a whole, and that's stated right here in the IPS. It says these restrictions operate on the variable program's aggregate assets
Got it.
and are not applied to each investment
Thank you.
option
Very
separately.
clear. Thank you. Thank you for clarifying that. Okay.
And anything that's in a common fund or a mutual fund, I mean, by asset size is relatively small compared to the whole $15 billion shooting match.
Got that.
Helpful.
Yep.
Shut up.
Right. Although
Just be on mute.
that is true right now. Presumably, if the index funds grew, right, that could change. But at the moment, that's true for sure. And then just one other question. It says, you know, derivatives are permitted within the 5% and 2% and 15% or whatever. Do we have any investments in derivatives in the variable funds? Like maybe the Crescent thing, does that include derivatives?
Susan, yeah, I'll have
investment-
Susan answer that.
Sure. Our investment in GMO can have a very small amount of derivatives in it. And so GMO, how much do we have in GMO? Maybe 400 million. I don't have the numbers in front of me because I'm trying to keep paper down. But so there could be a very small percentage of that 400 million could be in some derivative format if you include futures. Okay, in our in the 55% that's invested in the Russell 3, there could be a modicum of futures in there. If you call futures derivatives, it's possible that 2%, but there's no way we get to the 15% limit or the 25% limit because it's very small. So there's, yeah, targeted little bits. Okay, I'm sorry, noise in the background. Of course, the grass is getting cut while this is happening.
I can't hear it.
And John, to follow up, I concur with Valerie looking back. There are some little nuances behind it, but the general rule is you look at the actual mutual fund held at this point, not sort of a complete look through of everything. There are some nuances there, but that's the basics.
Yeah.
Okay.
We can clarify that because I'd actually like to, I mean, I did not think mutual funds counted towards the basket. So we would, if I need to be educated on that one too, that would be good. But we can clarify that.
Great, thank you.
Okay. So Susan, the next steps with this is we'll bring it up. You'll address John's comments, and thank you, John, for all of that. And you're on mute, Susan. Susan, you're on mute. Susan. Oh, Susan.
Sorry, I was
there you go.
Yes,
I'm sure you said a lot of great stuff.
I did a lot of great stuff. Too bad I can't be brilliant twice in a row. But yes, in general, we're going to incorporate the comments we've already talked about. I know there were other comments that John had that we're still working on the right language, but they're very helpful. We're moving forward, you know, and thanks. And anybody else who has any other comments, the comment period is still open, or what does this SEC call it? Yeah, the comment period is still open.
Okay, perfect.
Thank you.
Okay, thanks.
Great. Okay. Do we have anything else for public agenda? Public session, anything else? Okay. Then is there a motion to move into executive session? And I'll just say it's 11:21. We'll take the motion, move into executive session. I'll give everyone 10 minutes. We'll reconvene at 11:30. Does that sound fair?
Yes.
A little 10 minutes. Okay, I got
You
John's.
are just and fair chairperson.
All right, excellent. So we'll make the motion, we'll do all that, we'll move, and then what does Liz want us to go in there and then put ourselves on mute? And then
I'm transferring everyone over. You'll see something pop up on your screen to go into the breakout room. Just accept it. If you do not receive that invite, just wait for us here. We will return after executive session.
okay, so let me do the motion and everything. Is there a motion to move into executive session?
So moved.
Thank you, Mr. Brown. Is there a second?
Second.
Thank you, Mr. Adler. All those in favor of moving, please say aye.
Aye.
Thank you. Any opposed? Okay, we're moving into executive session. When that pops up, join, and I'll see you at 11:30. Okay, all right, nothing else. So then we will go back into public agenda, public session. Do I hear a motion to go back into public session?
So moved.
Thank you, Mr. Brown. Do I have a second? Thank you, Mr. Kazansky. All in favor?
Aye.
Aye.
Awesome. Any opposed? Okay. And we are back at TRS's investment meeting. Susan, will you fill us in?
Certainly. In executive session, 2 manager updates were provided. There was a discussion of the procurement of a service provider. Consensus was reached, which will be announced at the appropriate time.
Thank you. Does anyone else have anything else for the investment meeting? Okay, seeing nothing. Is there a motion to adjourn?
So moved.
Thank you, Mr. Brown. And is there a second? Thank you, Ms.
Second.
Vickers. Excellent. All those in favor of adjourning?
Aye.
Aye.
Thank
Aye.
you. Any opposed? Okay, we stand adjourned. Thank you, everyone. We will see you at the next meeting. And
Thank you.
well.
Stay
Have
safe.
Thank
a
you.
wonderful weekend.
Did a good job.
Bye,
Deb.
everyone.
Enjoy the long weekend, everyone.
Good luck with these
Bye.
schools reopening.
And I just,
Hey.
Enjoy the school year.
I just want you all to know, I don't know
Enjoy
if
this.
you realize that the PEP did approve the DOE budget on August 19th, including the $3.2 billion pension expense. So you're welcome.
Thank you so much, Natalie. We
You're
appreciate
welcome.
it. Be good, everybody.
Bye.
Okay, good. Okay.
Bye.
Thank you.